Ladies and gentlemen, it gives me great pleasure to introduce you to the last of our webinar series on transaction tax. Over the year, we have covered facets of transaction tax issues and solutions that covered from corporate reorganizations, M&A and deal structuring, overseas expansion, and IPO planning. Today's session focuses on startups and the key issues in incubation and fundraise that we have seen across the spectrum from where we have advised startups on. There's no better way to finish the series than on a high note that captures the future of India. Now, this topic also follows on some of the insights that we actually gathered during the publication of our report titled Fueling Entrepreneurship, which was authored jointly with NASSCOM and the TIE NCR chapter and released by NASSCOM in its product conclave in November in Bangalore. Now, in this session, we hope to offer insights and solutions and some key structural considerations that startup entrepreneurs like you should keep in mind while setting up, expanding, and or raising funds. I am joined by my colleague Surabhi, who is a director with the transaction tax practice in Grand Thornton. She is a chartered accountant having over 12 years of experience in providing advice on transaction tax matters. Her expertise lies in providing end-to-end advisory solutions in relation to various forms of corporate restructuring and transactions for achieving varied objectives. Welcome, Surabhi. Now, if we were to kind of jump into our presentation for today, let me set the context first. And if I can request my colleague to bring up the slide. If you see the first slide around the statistics of how startups have evolved in India, as you can see, India has significantly moved the needle in terms of now becoming the third largest startup ecosystem after the US and China. And therefore, this is a success story which this government as well as the startup entrepreneur community in the country should pat their backs for. The success is particularly noteworthy with the ecosystem still being nascent and evolving. So there are issues like access to capital, awareness about opportunities, challenges around ease of doing business, regulatory hurdles that continue to be key concern for startups. And this presentation, we've also highlighted some of the concerns and possible recommendations as well, which we have been kind of putting through to various forums, and or some solutions that could be of use to you in this environment. Now, the latest statistics actually points to the fact that almost 84,000 plus startups have been registered in the country till November of 2022. This was a mere 452 in 2016. So now we can actually proudly also say that the success rate of startups in India is also much higher than in any other country. Now, what government is estimating is that the startups should contribute to between 4 to 5% of India's GDP over the next 3 to 5 years, which is currently around 2.5 to 3%. So that in itself shows the need for creating a robust environment as well as creating a more vibrant environment for startups to thrive in India. Now, if we were to kind of get to the next slide, so this is outcome of our survey, and what we see is that the usual suspects are the hurdles that the startups face today. So, for example, almost 39% of startups we surveyed felt that there is a lack of a strong platform in India for investors to participate in startups. Now, to just step back a bit, the Innovators Growth Platform that SEBI has regulated is currently a carve out within the main board of the BSE and NSE stock exchanges. It's aimed to facilitate listing of new age companies in sectors like e-commerce, data analytics, biotech, and technology sectors generally. But over time, SEBI has also, we must say that, reworked the IGP guideline to make it more liberal to attract such startup companies with early stage investors who find listing in the main board a challenge. Even in March 2021, SEBI actually further eased the rules around listing on IGPs in order to make the platform more accessible and provide an avenue to startups to look to raise funds, that is Series B and beyond. Now, what is key consideration for qualifying in the IGP? And most of us typically don't view the IGP in so much significance, but given the fact that listed shares do give long-term capital gain rate benefit for stocks, there is certainly a need to consider this in more seriousness. The IGP framework itself has some issues which I'll just touch upon. One of the key conditions to qualify for the listing in the IGP exchange is that at least 25% of the pre-issued capital of the startup should have been held by certain qualified institutional buyers or accredited investors, including large family trusts. This has obviously means that SEBI is saying that you must have a credible set of investors already in your entity to be able to move into this regime in the IGP listing sector. And to that extent, it is logical as well, because we do not want seed, series A, etc., looking for fundraise from the public in general. Now, the other thing that IGP limits is the participation of investors who must also be accredited into the platform to be able to participate in such companies. So therefore, there is a contra argument that there's really, if a institutional investor is coming into the startup entity, why do we need to go through the complicated need to invest through a listing mechanism, unless there is a very strong need or desire to finally go into the main board, which means you will migrate from the small board into the main board. And typically what we have seen is most of the companies who use this route have that ambition, and therefore this is the first step to be able to reach that ambition. Inviting therefore a larger group of accredited investors into the platform to allow the larger market to choose up investing into a offering in the IGP is something that the SEBI and the government should think through. And I'm sure they have already widened the base in the 2021 amendment, but there is a bit more that can be done to invite a larger group of such accredited investors who are willing to take this risk. So obviously an evolved set of investors is needed, but a larger set of such investors is something that is useful to have. I think the biggest concern has been the harmonization of the long-term capital gains tax rate that is levied on residents and non-residents. So non-residents technically get a lower tax rate for long-term capital gain, which is 10%, whereas residents in long-term rates are at 20 plus surcharge. So to that extent, there is a 10 to 12% differential if you were to add all the surcharge, etc., for residents to pay additional tax as compared to non-resident investors. And I think this could be one of the biggest enablers for domestic fundraise to kick in, if government were to harmonize the tax rate between the resident and non-resident investor class themselves to bring it to, say, a 10% rate. Uh, in fact, today, less than 5% of the total capital that a startup sources is what is sourced domestically. So almost 95% plus capital is actually sourced from overseas. And therefore, incentivizing the investor set with simply a harmonization of the rate in itself will be a big kicker for us to surmount this problem. And hopefully government is looking at it in this year in its budget. Uh, the next point is 36% of startups surveyed also felt that there are lack of innovative funding instruments in themselves, and SEBI has been strict in the listing norms that apply to seek funding from India. Now, logically so, IPO norms prescribed by SEBI have been relatively complex depending on the nature of transactions, and the norms provide for pricing for lock-in period, timelines, and approval and compliances, because the measure for raising public funds in India is certainly strict. Um, SEBI, as I mentioned earlier, has provided the IGP platform, which is certainly a much more easier platform to list, but the accredited investor class needs to be more proactive and probably kind of take more participation in that platform for the startup community to look at the IGP platform more seriously. Other instruments of funding like venture debt funding, which is an alternative to commercial bank debt financing, where investors could lend money to an entrepreneur for a given rate of interest and not uh, is not yet involved, with SEBI limiting exposure of venture funds to invest in such instruments. Of course, there is a reasonable number of investments going through venture debt, but this can certainly go up in the nature of the instrument that could be a possibility. The fund of funds for startups that the government had set up in 2016, which is managed by SIDBI, has been a very good hit. And SIDBI has run this operation across all India funds, regional funds, the India Aspirational Fund, and the Aspire funds. So essentially, this fund then contributes to make the alternate investment funds which invest in startups to have a catalytic effect. And therefore, there is certainly a good impact of this fund of funds in the previous success that has happened. And it has unlocked a much larger pool of monies for startups. And in fact, what is also seen is that the VC community themselves have grown over 5 times since the last 5 or 6 years, merely because government is backing this through the SIDBI mechanism of fund of funds, where 80% is committed through the fund itself, but 20% gets committed through the fund of fund regime. So to that extent, more such innovative funding mechanisms need to be put in place to encourage investments into startups. More can be done in terms of providing collateral-free debt for aspiring entrepreneurs. There are credit guarantee schemes, and there is the Mudra scheme and the Stand Up India scheme, but more can be done to disseminate the features of these schemes widely. So most startups even don't know that such schemes exist for lending into them without collaterals. And this is again administered through the SIDBI. The next point being that at least 22% of the startups believe that there is a wider range of funding avenues that exist in the overseas market. And there is a diverse investor profile as well. And therefore, there is a higher valuation expectation that plays out for investments from overseas. And therefore, there is a need to strengthen our policies to enable fundraising from overseas markets. Now, with the recent RBI notification, which kind of liberalizes the Indian companies from investing into overseas headquarters, which have then Indian step down subsidiaries or the round trip structures, as we used to call them, which RBI has relaxed to permit such structures up to 2 layers of subsidiaries, has made an impact. But the direct overseas listing norms are still to be notified, and that is one more element that could kind of open up the possibility to raise public funds from overseas markets, which certainly could be at lower cost than what India is seeing today. So to that extent, that is one window that still needs to be opened up by the government. Needless to say, the last but not the least, and that is the concern for today's presentation, is the fact that startups do find navigating tax policy in India to be complex. And that ranges from income tax to international tax to indirect tax policy to transfer pricing. And therefore, there are several issues that a startup and its founders or investors are faced with to navigate in this environment. Now, we have discussed these in greater detail in the ensuing slides, but needless to say, this is not just a challenge for startups, but also for evolved businesses to kind of manage. And therefore, there is a need to certainly simplify, if not let go of tax revenue for the government to consider in this situation. Now, if we kind of move to the next slide, this is a bit trite, but useful for us to recollect in the fact that there are some benefits that the government promises for startups. And startups by definition are startups that qualify under the DPIIT policy. To name some of the key exempt benefits that are available, the first being the exemption from long-term capital gains tax for investments in equity shares. So if you as an entrepreneur sell your residential property and then utilize that to invest into the equity shares of a startup, which you must do within 1 year from having sold the property and or within the due date of filing of the return, you should be able to claim an exemption from the long-term capital gains completely. And of course, the proceeds have to be utilized for purchase of new assets, etc., by the eligible startup. But this is one thing that government has enabled. Of course, the principle does sound a bit skewed, that you would expect a startup to sell residential property to invest in a startup. If there was a bit more flexibility in the interpretation of the property definition to include any other immovable property, including industrial or commercial property, that would kind of be a good kicker for the startup promoters to fund their businesses through this mechanism of sale of assets that they may be holding from the past. The next one being angel tax, and this is a much talked of benefit. Shares issued at unjustified premium that exceed the fair market value of the shares of a private company get taxed in the hands of the private company itself. And therefore, there was a need to carve out a specific exemption. The exemption is available for startups which are recognized by the CBDT for this purpose. So in addition to the recognition by DPIIT, there is a specific exemption required to be obtained by the startup from the CBDT for this exemption. Such exemption is also available for investments by venture capital funds. So to that extent, a reasonable step. What is perhaps missing here is secondary market transfers of shares of a startup still get caught in the mischief of tax or a deemed tax position, especially where share swaps are being considered. And to that extent, there is need for government to kind of consider if there could extend this to a larger spectrum. But as things stand today, this is certainly a benefit which a startup needs and has been offered. The next is the benefit of carry forward of losses in case of change of shareholding. And essentially, Section 79 in income tax law says that a startup whose shareholding pattern has undergone a change over 51% in voting rights cannot carry forward its business loss. With this benefit, the startup can still carry forward its business loss as long as the shareholders continue to hold the shares held by them when that loss was incurred. And to that extent, the benefit of carry forward of losses uh, kind of divorces the need to hold 51% or more, but still expects the founder group to continue to hold what they owned as shares in the company, in the startup company. Reasonable ask, but there are some nuances that you need to be careful of in terms of if you were to transfer shares inter se between the promoters in the event of such change of shareholding, and what happens to such transfers is a bit of a conundrum there. The tax holiday for 3 years is certainly uh, a good one, except that it is for a limited period of 3 years in a block of 7 years. And most startups in their life cycle journey uh, do not kind of, either they sink very quickly or if they were to make profits, they will make profits very quickly. But given the regime of the tax holiday, it's probably the loss carry forward which is more important than the tax holiday at this point in time. But 3 years in a 7 years is certainly available as we speak today. The last but not the least is the deferment of withholding tax on stock options. The ask was a bit different when initially this was sought for as a SOP, but the way it is played out is that now the government does not expect the employer to withhold tax in the hands of the shareholder, the employee shareholder, when an exercise happens of the shares of a recognized startup, where the withholding can be deferred up to the expiry of 4 years from the end of the relevant assessment year in which the allotment of the equity share took place, or on the event of the sale of the shares that are so issued by the employee, or on the date of cessation of employment with the employer. So there is a deferment of up to a maximum of 4 plus the current year's period for an employee to not get taxed on the perquisite value on which the employer is expected to deduct tax. But there are some issues around how this plays out, because most option plans do not expect an exercise event to happen till such time there is visibility for the sale. So in any event, the benefit was already embedded in the way the stock option plans were planned earlier. But if this were to be extended to stock options qualifying in themselves as securities, that could have made more impact in the scheme of things as we stand today. But this is one of the last benefits that the tax department offers for startups. In addition to this, there are some SOPs in company law as well for startups to look at, uh, which uh, which are more process oriented and or employee oriented in focus. Now, if we were to kind of move to the next slide, and I'll quickly run over this slide in the sense that most of us know that the funding life cycle of a startup spreads across pre-seed, which is essentially bootstrapped investments by the founders themselves, to seed, to early stage series fundings, and then from there on to growth, and then beyond startups. Now, what probably needs more attention of in the funding cycle that we have seen is the early growth and the beyond startup stages, where innovative funding mechanisms, as we spoke of in the previous slides, need to kind of get strengthened. Now, listing in itself is an event, and therefore is carved out distinctly, and is a choice that startups can make. If they are happy with the growth stage and have realized their dreams in terms of having funded themselves well and or having made profitable businesses for themselves, they do not necessarily need to go through the listing mechanism in itself, but listing is the final door step that everybody would like to be in, especially in a corporate world, which measures you for having taken the last step of raising funds from the public to do business and to grow. So listing in itself, there are broadly two options that people can look at. One is domestic listing options that we just spoke of, and there is overseas listing, which is currently allowed only on an indirect manner, which is the what is called the ADR GDR route, and that route is limited for listed companies in India. And there's been some back and forth in this between the policy that existed from 90s onwards till the 2000s, and then in the current state. But in the current state, we have kind of stepped back to say only listed companies in India can list overseas through the ADR GDR mechanism. So a minor tweak to allow ADR GDR listing for unlisted companies in India in itself perhaps will open up the possibility for an overseas direct listing through the ADR GDR route. There is, of course, a strong need and a push to operationalize the overseas direct listing regime, but that still needs to be flushed out in full in context of Exchange Control Law, Companies Act, and SEBI. And needless to say, income tax, unless we harmonize the capital gains tax rates, which is the first thing or the ask for resident and non-resident investors, can be administratively challenging and complex for companies to administer who have directly listed from India. So therefore, some thought on tax policy also needs to play out in that regime. Government certainly has strengthened the IFSC regime to allow startups to have a choice to list through an IPO or a SPAC mechanism, a de-SPACing mechanism in the IFSC regime. And there is tax certainty that has come through and hopefully will come through in terms of adding to the list of securities equity shares of an Indian company post the IPO, or a foreign company for that matter, in the IFSC regime. But needless to say, the GIFT City IFSC regime is certainly an interesting concept that you should watch out for in the possibility to list your companies uh, in the public space. Uh, in FEMA itself, a resident wanting to swap his investment in an Indian company to the shares of the foreign entity in a de-SPACing or an overseas listing scenario still kind of proposes a hurdle with the requirement of RBI approval being there. And we are hoping that some of this could be standardized as we go along in terms of getting a general permission, as is the case for cross-border mergers. If we move to the next slide on holding company structures, and this is the biggest debate that you may have when you put a structure in place as a startup. Now, if you have an Indian business which has the ability to scale into an international business, this is certainly a very big problem for you to worry about. But if your business is focused on India and you believe that the solution is for an Indian market, then perhaps structure one, which is essentially the non-resident and the resident shareholders owning an Indian company running its operations in India successfully, is the structure for you to logically look at. But if you have international aspirations and operations that can certainly grow out of India, that's when you are in this dilemma of how to own the structure. And as you can see, structure 2 and structure 3 have their own nuances. Structure 2 is a structure which is now permitted by Reserve Bank of India, where resident entities could own a foreign company, which could also own 100% of an Indian subsidiary under it, which means the foreign company could be the most appropriate vehicle to raise funds for both resident and non-resident investors to come in. And that foreign company could then be the holding company for multiple foreign jurisdictions which fold under it. Of course, India's pound of flesh in taxing an indirect transfer still remains, and that in itself is, to be fair to the government, the right thing to do. But there are challenges in how this is computed and how this creates friction between the valuation principles that are adopted globally and in India. Is something that is playing out in controversy as we speak. So structure 2, certainly a possibility now under the current exchange control regime, with the caveat that if you do not have significant international businesses, the tax authority will anyway want to tax an indirect transfer, even if you were to dispose of the foreign company into an overseas non-resident at a future date. So that's the way that would play out in structure 2. Structure 3 is a value proposition which is in a sense split between the India business being held parallelly by the non-resident and resident shareholders through an Indian company, and the foreign business or overseas business held in a mirrored ownership through a holding company or through directly into a foreign company, depending on the scale of that business, where India's ownership does not fold directly into the overseas holding company. So to that extent, there is a mirrored ownership that plays out here and this is a bit of a funding challenge for attributing growth to India and overseas. But if India is merely a back office and your growth engines are overseas, this could be a good structure for you to consider without the controversy of an indirect transfer rule hitting you in India. for divestment, for certainly for the non-resident shareholders. For the resident shareholders, anyway, the arbitrage is only if government were to consider a lower tax rate for long-term capital gain. But that's really how this would play out in thought. And at the structure stage, at the stage when you are in concept design, this may not look to be money worth investing into, but as you grow and when you grow suddenly, this can be a significant challenge to rework. So if you got your structure right in the first place, that's how you should kind of plan for investments as well as for divestments in the future. And that's really the key takeaway, that planning for this should happen at an early stage. We wouldn't want to say that you should do this in seed or pre-seed, but certainly before Series A kicks in, or certainly before a venture fund or a larger investor is coming into play. That's how we would want to place this out for you to consider. Now, the next slide is around typical funding instruments, and I will have my colleague Surabhi talk more about some of these instruments. There are typically two kinds of instruments. One is the non-debt instruments, and the other is the debt instruments if you were to look for funding from overseas. And funding from overseas typically is governed by the foreign direct investment regulations rules, and which is now defined in the non-debt instrument rules. And these cover equity instruments, which essentially include compulsorily convertible instruments, convertible notes, as well as stock options and or sweat equity. Convertible notes are an interesting concept, which kind of play out between a debt and equity, with the characterization being debt for the initial period. And then when a conversion happens, the investor sits on the cap table as an equity holder. And there are some nuances around taxation and regulation there, which my colleague will kind of pick up in the ensuing slides. Stock options have been conventionally used as a very good tool to incentivize management in such situations, and especially stock options for startups is a considerable norm as a kicker for long tenured management to continue. And recent trends indicate that stock options are actively deployed in hiring strategies to attract and retain talent. Now, we all know that startups such as PhonePe, Licious, etc., Wakefit, ShareChat, etc., have rewarded their employees in the recent past through a buyback mechanism of the stock options themselves as well. So there is some interesting play around the buyback of stock options in terms of how that plays out for employees as well as employers. But unless tax policy liberalizes some of the restrictions around interpretation of a buyback of a security, being in the nature of a stock option, there could be limitations from a tax perspective for promoting buyback of options in themselves. But company law does provide for this, and therefore to that extent, nothing needs to be done from a company law perspective to facilitate such a buyback. Debt instruments certainly possible now with external commercial borrowings or corporate loans from overseas very much being possible, and the other possibilities of non-convertible debentures or preference shares, which could be tax efficient instruments for raising debt instruments but they are highly regulated and do face the scrutiny of the Reserve Bank of India on a very regular basis for such a fundraise. Till such time there is a lower income tax withholding tax rate on the interest payout for such debt instruments, which is currently at 5%. That's available till March of 2023. This instrument would certainly be a low tax option for investors to consider in the convertible, non-convertible instrument space. There are some nuances around the FDI policy as well, which kind of kick in for convertible notes. And if I can bring in my colleague Surabhi in for this conversation and take the slides through from here on. Surabhi, over to you.
Thanks, Sridhar. So the biggest challenge in fundraiser startup has to deal with is to attract early stage investors. Investors generally have a certain level of risk tolerance and investment timelines to be adhered. The majority of startup companies, they rely on some form of external sources of finance, like the angel funds or traditional venture capitals, or it could be high net worth individuals or even friends and family. But some of the key challenges which are faced in the traditional modes of fundraise, that is equity or preference shares, is first of all is the valuation of the startup itself. So where a startup company is at a seed stage, it may not have had the time to show much traction in terms of its revenue or the products. But for raising equity funds, it's imperative to place a value to the business, which is quite difficult to establish in the initial years. Another challenge which is faced is that at a pre-stage or a seed stage, any sort of equity fundraise in the form of a secondary sale by the promoters result in tax implications for them. Or in case of a fresh infusion by the investor, it will lead to a dilution in the stake of the investor at the early stages. So therefore, equity funding is not really the most optimum fundraising solutions in the early stages of a startup, because due to involvement of too many stakeholders, there will be less autonomy with the promoters in running of the business operations, which can also sometimes result in a slow decision making also. Now, to ease out these challenges which were being faced by the startups in fundraise and also to boost the economic growth, the RBI introduced the concept of convertible notes in 2017. Convertible notes are basically instruments which represent debt which is repayable at the option of the holder, or they are convertible into equity shares within a period of 10 years from the date of issue. Now, this timeline of 10 years has been recently increased in April 2022 this year. It was earlier a period of 5 years. So the risk was even greater there. So basically, a convertible note is nothing but a hybrid instrument. Typically, the equity investors, they cash out during a liquidity event like the sale of the company shares or when the company goes public. But these notes are technical debt, and on maturity, a note holder can also demand a payback, though they do contain a provision in which they will automatically convert into equity at the then prevailing fair values. So what is the benefit that is available with the issuer because of this convertible notes? Number one, as we said, the valuation is not required when the convertible notes are issued. So this valuation exercise is kind of deferred until they get converted into equity. Another benefit is that there is no loss or sharing of control over the management or the business decisions with the investor unless they get converted into equity. Because typically, until they get converted, they are akin to debt funding. Even from a documentation perspective, issuance of convertible notes is far simpler as compared with raising equity funds because it requires a lot more efforts to justify the valuations, prepare business projections and future business plans. And it may also involve a lot of FEMA compliances and reporting. Even from the investor perspective, a convertible note is an attractive instrument, as unlike other forms of convertible instruments like compulsorily convertible debentures or preference shares, the investor here has an option to convert into equity rather than an obligation to convert the debt into equity. So the investor can always demand a payback. But in spite of all these benefits, there are again a few challenges also which a startup may face in relation to convertible notes. The first challenge is the minimum investment threshold which has been prescribed, which is that at least 25 lakhs should be raised in one single tranche. Now, this may act as a hurdle for raising funds, especially where the funds are being raised from small investors. And another key risk is that if the startup is not able to perform up to the expected levels, or the expected increase in the valuation is not achieved, the note holder may actually demand a payback, which may put the startup in a great financial stress and may, in worst case scenarios, it may even lead to bankruptcy of the startup as well. So if we move further, now FEMA valuation, some of the other key considerations in relation to convertible notes, the foreign exchange considerations we already discussed, valuation aspects we have covered. Now, if we come over to the taxation aspects of convertible notes, as we highlighted that these notes are in the nature of debt. So any interest which is paid on a convertible note is a tax deductible expenditure for the entity. The startup would also accordingly need to comply with the applicable withholding tax obligations. And in case where the payments are being made to a non-resident, it would be subjected to the treaty benefits available if any. Conversion of convertible note into equity shares is per se an exempt transaction. It is not subject to capital gains tax. But the price at which this conversion takes place is an important consideration from the perspective of deemed income provisions. So for example, if the conversion price is more than the prescribed FMV for tax purposes, then the difference between the conversion price and the FMV is taxable in the hands of the startup unless it has sought a specific tax exemption by filing the applicable form. On the other hand, if the conversion price is less than the fair market value, then the difference will be taxable in the hands of the investor. So the conversion price is a thing which one needs to look at. Post-conversion, when the converted shares are sold by the investor, capital gains tax will arise in the hands of the investor, again subject to treaty benefits available if any. And for the purposes of capital gains tax computation, the period of holding should be ideally available from the date the notes were issued to the investors. Now, under Companies Act, there is no specific treatment for convertible notes. There is no separate provisions which is provided. It is just treated like any other debt instrument. And the key compliances will be similar to the ones as are applicable in case of a normal debt funding, like board approvals or shareholder approvals as may be applicable. Now, if we move over to the next slide, in this slide, we have captured a brief comparative snapshot between the equity instruments and convertible notes. So for equity or preference shares, the dividend is basically a risk-based return. It's not an assured return, but for debentures and convertible notes, it's an assured return in the form of interest. The notes are redeemable at the end of the maturity period, but for equity or any other compulsorily convertible instrument, there is no redemption period, but a capital repayment is possible. But the capital repayment would also involve a prescribed process like capital reduction, which is an NCLT approved process, or a buyback of shares, which may have its own considerations like the percentage of shares which can be bought in a single tranche or availability of free reserves, etc. No such considerations are applicable for redemption of convertible notes. Again, there is no minimum investment limit which is prescribed for the equity investment. And as we discussed for notes, there is a minimum investment of 25 lakhs in a single tranche. Similarly, there is no maturity period prescribed as such for equity or the compulsorily convertible instruments. But for convertible notes, the maximum maturity period is 10 years, both under the foreign exchange regulations and the corporate law. If we talk about the tax considerations, they are more or less the same. There will be a withholding tax implication on the dividend or the interest payment. Dividend is a non-deductible expenditure, while interest is a tax deductible expenditure. Again, the capital gains tax implications will arise both in case of a capital buyback or a capital reduction, as well as on transfer of shares in case the notes get converted into shares. So It's just that the conversion of notes into equity at FMB is not a taxable event. So now if we move further, okay. So besides the funding instruments, another important consideration for a startup is the choice of entity. Now, the basic two types of entities which are uh, under consideration for any startup is a limited liability partnership and a company form. But there are various factors basis which the startup entrepreneurs can decide as to the choice of entity for undertaking the startup business. One of the key factors is equity funding. Now, equity is in the nature of a permanent capital and which is essential for maintenance and growth of a business. LLP cannot issue shares. It can only raise capital in the form of a capital contribution. And actually, this may become a disadvantage in the growth stages of a business. Further, as the business grows, the promoters may want to raise public funds through IPO, etc. LLP cannot be listed, and therefore, this kind of a growth can be only achieved in a company format. Another important aspect is business expansion. Now, there are restrictions and approval requirements applicable if LLP intends to invest outside India. So accordingly, if any startup has aspirations for going international, then a private limited company form is a better choice. Furthermore, as the business grows, there may be some reorganization requirements like there may be a requirement to consolidate the acquired targets or hive off the non-core business or assets by the uh, startup. So these kind of reorganizations can be taken place through a tax neutral manner in the form of merger or demerger. They're not possible in case of LLPs. So in the long run, actually the company form serves better. Private company also offer the best type of exit strategies for the promoters. Now, the shares of a company can be transferred either in part or in whole to any other entity or acquirer easily without any hassles. And at the same time, the continuity of the business as a going concern shall be ensured. But in case of an exit from the LLP, actually the transfer of ownership interest will require consent of the all other partners. So it is a restrictive exit to that extent. And not to forget, the company also offers the benefit of distinguishing between a shareholder and the directors or the key personnel. So the company offers the flexibility of issuing ESOPs to the key personnel who are engaged in the startup business and therefore helps them to retain them longer for a longer time. Whereas this flexibility is not possible in case of LLP. So there are various reasons due to which the promoters may opt for a company form, but at times due to the capital issues or the compliance issues, etc., the startups may be started as LLP and then they can be converted into company form in a tax neutral manner as the business continues to grow. Now, if we move over to the next slide, some of the key distinguishing factors between a company and an LLP is that LLP requires a minimum of 2 partners. There is no limit on the maximum number of partners, but in a private limited company, there is a restriction of not having more than 200 members. If we come over to compliances, there are compliances which are applicable to a company under the Companies Act provisions are more complex as compared with LLP. All the companies, whether they are public or private, they are required, irrespective of the share capital, they're required to get their accounts audited. But in case of LLP, there is no such mandatory requirement. An LLP is required to get the audit done only if the prescribed thresholds are met. Like if the contributions exceed 25 lakhs or the annual turnover of the LLP exceeds 40 lakhs. Other compliances also, LLP is only required to file just an annual return and a statement of accounts and solvency. If we talk about the tax rate which is applicable, the applicable tax rate on a company lies in the range of 22 to 30%, again depending upon the turnover of the company. But for LLP, the applicable tax rate is 30%. So while here the applicable tax rate for a LLP is higher, it is important to know that any surplus, that is the post-tax profits which are available with a company, they can be repatriated to the shareholders either in the form of dividend or a capital buyback, but that will entail tax implications for the shareholders. But in case of an LLP, any post-tax profits actually belong to the partners and they can be withdrawn in the form of a capital withdrawal without any further tax implications. Again, the shares of a company are easily transferable, but the transfer of ownership in LLP is not so easy or simple, and it will involve a change in the LLP agreement each time. In case of death of a shareholder, the shares are transmitted and they are transferable to the legal heirs. However, in case of LLP, the legal heirs are only entitled to the withdrawal of the deceased partner's capital. There is no provision for an automatic admission of the legal heirs to the LLP. So these were some of the key distinguishing factors between an LLP and a company basis which a startup promoter can decide whether to start its business in an LLP form or a company. Moving over to the next slide. Now, it's very common for the startups to raise funds from the overseas. One of the important considerations for the investor community is to decide whether to directly invest into the startup or invest through an intermediary holding. Now, the basic determining factor is an analysis of the tax treaty network between the investing jurisdiction and IHC, as well as IHC and India. So, the determining factor would be what would be the withholding tax implications in India on upstreaming of or payments like dividend, interest, royalty payments to the IHC jurisdiction versus the withholding tax applicable in India if such payments were to be made to the investor jurisdiction directly. And taxability of such income in the intermediate jurisdiction versus taxability of such income in the investor jurisdiction. Another determining factor would be the tax implications on exit from India. For example, post changes in the Singapore or the Mauritius treaty, in most cases now the capital gains are taxable in India whenever an investor desires to exit from India. Now, if the investor has invested through an intermediate jurisdiction, the investment can also be transferred at the IHC level, and it may not result in an immediate exit tax implications in India, of course, subject to evaluation of the indirect transfer tax provisions also. Now, in addition to the taxability of income sources, another key aspect to consider while investing is that is there any commercial rationale also in the IHC jurisdiction if the investor is making investment through an intermediary jurisdiction, especially after the introduction of the MLI clauses in the tax treaties. In most treaties, the treaty benefit is available on the condition that the investment is not made with the objective of claiming a tax benefit under the treaty. So having a commercial rationale in the holding jurisdiction has gained great significance in the last couple of years. Moving to the next slide. Okay, this is just a brief snapshot of the few tax treaties between the few holding jurisdictions with India, without going into much details, just to give you a flavor. So, for instance, if the investor is from a country which does not have a treaty or does not have a favorable tax treaty with India, but it has a good treaty with the IHC jurisdiction. Now, in this case, if the Indian entity had to pay interest to the non-treaty country directly, then the local laws would have applied and a withholding tax of 20% would have applied. Now, if the interest payment is being made to an IHC jurisdiction with which India has a favorable treaty, say Mauritius, in that case, now the withholding tax on interest will reduce from 20% to 7.5%. Similarly, in case of an exit, so if the shares of the Indian company are transferred by, say, a Netherlands-based IHC jurisdiction to another non-resident, no capital gains will arise in India. So therefore, in a similar manner, evaluation of the treaty benefits as well as a commercial justification for having the IHC entity in between is an important consideration for raising the foreign sourced funds in an Indian entity. With this, I would hand over the discussion back to Sridhar for discussing a couple of more aspects or considerations in relation to the foreign investment in startups. Over to you, Sridhar.
Thank you very much, Surabhi. Foreign investments certainly have the nuance of first the tax elements that Surabhi just spoke of in terms of the tax on dividend interest, royalty, and or tax on capital gains. But foreign investment in itself also creates a new set of regulations that was otherwise not applicable to resident Indian entities. If this structure has a overseas investor entity coming in, so therefore the nuances that apply to any foreign investor investing in any of the regulated sectors will need to be kind of measured. And while we say that our foreign direct investment policy is considerably liberalized in the sense that we are able to invest across sectors except for certain prohibited sectors, there are certain sectoral nuances or conditionalities that creep in that need to be kept in mind while investment happens as a foreign investor. So, for example, the classic example being policy on foreign direct investment into companies which are into e-commerce, and in that the government's policy on the e-commerce segment has been that if you are the owner of a technology platform which is promoting e-commerce in India, then as a foreign owned entity, that platform should not own inventory. So inventory based business in a tech platform or in the nature of an e-commerce segment is a prohibition. Whereas on the other hand, if you were to classify foreign investment under the trading arm, which means either you are into a B2B trading model, which is a business to business wholesale trading model, or where you are a single brand retail trading model. Those are generally permitted with certain conditionalities attached to the volume of trading that you would do between wholesale and retail, and also the volume of sourcing that you would need to undertake if you were to do a single brand retail trading activity in that entity. Of course, there is an expectation that there would be a physical store in that trading model, and not all of it will be traded or business would be transacted through a platform. So to that extent, there is a need for a physical store or a retail outlet or a wholesale outlet for such a model to efficiently work. Having said that, services in themselves are totally free of restrictions and therefore permitted completely under the automatic route, subject to conditions that these services are not regulated by any regulatory agency. And therefore, if any regulation was to apply, then such services would necessarily need to go through the government approval route. That applies to financial services as well, which until about 4 years back was there were different policies pursued by the Reserve Bank of India for generally for the financial services segment, and a different set of policy for foreign investment in financial services segment. But now it is got completely aligned to the extent that only unregulated financial services in the foreign direct investment regime is now subject to a specific permission of the government of India, and any financial service that is otherwise regulated by the government through the Reserve Bank of India or the IRDAI or any of the other regulatory agencies that apply for financial services would then be governed by those set of regulations only, and there is no distinct regulatory oversight in addition to that required for such financial services to have foreign investment on. But what flows through in between is services which are unregulated, and that's when innovative financial services models which are bordering between services and financial services are the ones that get need to be addressed specifically from a foreign direct investment perspective. The same applies to agriculture, which is certainly a highly regulated foreign direct investment policy as of now. What is permitted is only limited forms of agriculture and or trading in certain agriculture commodities, etc. But that too on a wholesale basis, and therefore with the oversight of the regional mandis and or the regional state government policies, and that also plays out from a foreign direct investment perspective. Manufacturing essentially has been widened to include contract manufacturing as well. So if you get things made from another company in India and you are the owner of the brand and or the end product that comes out of that process, you are also a manufacturer of that product. So to that extent, contract manufacturing has enabled foreign investment to come in outside of the trading classification itself as well. So therefore, relevant for all of us to see if you were to attract a foreign investor in your startups. Now, if we go to the last slide, and then from here on, I will kind of get to some of the Q&A. Some of it is, or most of it is, I've tried to answer it on the chat box themselves. But if there is something more, we can kind of see if we have time. Now, looking at the last but not the least of the issues or matters for you to keep in mind is essentially how do you plan for exit? And most of the startups and the founders groups in themselves are geared for exit, unlike traditional businesses where family owned businesses would wish to continue to own these businesses for a lifetime and pass it on to the next generation. The tendency for startups and for founder groups in startups is to try and plan for exits as well at the right time with the right set of investors. So the exit strategy in itself is also something that plays out in the structuring discussions that we've had in the past in the previous slides. So from an exit strategy point of view, on the left hand side, you'll see what all are the broad possibilities that exist from the extreme of an public listing through an IPO mechanism to a strategic sale or a merger or an acquisition by you or by somebody else to give you an exit, to using the funds of the company to just merely buy back your investments and keep your ownership intact while your return on investment has come through a buyback mechanism, and or the last but not the least, liquidation or writing off of your investment if your startup were not to succeed are the extremities of the possibilities in the exit strategies that you should consider. Now, what all do you keep in mind when you look at this? There is foreign exchange law, there is income tax, there's transfer pricing, there is tax compliance, and there is time taken for approvals, etc. that keep in mind, that are to be kept in mind when you plan for an exit. So for instance, in the analysis of the holding company jurisdiction, there's also an analysis of whether or not you have an exposure in India on account of place of effective management for that holding company if you were to be owned ultimately by an Indian resident set of investors or promoters. So to that extent, how do you ring fence the effective management of the foreign company is a key element of how your structure passes muster the tax authority scrutiny in India. Similarly, transfer pricing is very significant with most of the relationships, be it capital or revenue of nature, getting scrutinized under the transfer pricing principles, where arm's length or fair valuations of your investments and or of your activities is a significant element to be kept in mind when you are doing your business. And as we all know, transfer pricing is a function of what activities you carry out, what assets you have, and what risks you maintain. So a function asset risk examination is really what you would end up doing for each of the entities in your structure to come to what would be reasonable for that entity to earn in a transfer pricing relationship. Uh, Thankfully, the ODI FDI structure regime has been liberalized a bit. So to that extent, we have some flexibility on Indian entities being owned from overseas. But there again, there is the exposure that if you were less than 10% investment in a foreign company, then you are not treated as an overseas direct investment itself, and therefore those structures then become questionable in terms of the ODI FDI structure. Uh, Tax in terms of compliance, which is both withholding tax when an acquisition happens, as well as in your positions in the tax returns that you file in various jurisdictions, will certainly matter in terms of how an investor looks at you when an acquisition happens, and how you are ready for a due diligence in your discipline of complying with the tax policy to give comfort to investors that tax is taken care of. That's an important element for you to plan when you are getting an investor, as well as when you are exiting yourself. Uh, Robust documentation again flows out from transfer price principles, but it's become important both from a corporate law perspective, as well when related parties are involved, and when you have common ownership and or common key managerial personnel running the business across jurisdictions. And last but not the least, valuation plays out very significantly in both in tax as well as in assessing the value of a business, whether in India or overseas. And valuation disputes in tax are high stake disputes with the extremities of not offering anything to tax versus offering almost 40+% of the gain to tax in India. And therefore, because of the extremities, value assessments have started playing significant roles in India, in certainly in indirect acquisitions as well. So to that extent, indirect acquisition or disposal of investments that derive significant value from India have started becoming the next level of disputes from a valuation perspective. Now, having taken you through all of this, uh, I know we are running a bit short on time, so I'm happy to take the Q&A in the chat box through individual mails that we will respond to you on. And given that this is the last of our presentations to you in the series of webinars that we have had over the last 1 year, I'd like to take this opportunity to thank all of my colleagues, including Suvira, Amit, Shabala, Ashna, Surabhi, Shubham, and all of my other colleagues and partners who in the firm have made this series meaningful with their insights and inputs. A special thanks to all of you, the audience, who have participated in making sure that each of the series in this webinar has been a grand success, and we have seen that as an outcome from each of our discussions that we have had over the last 1 year. I hope you have enjoyed listening to us as much as we have enjoyed preparing for these sessions. Wishing you and everyone around you a very happy and prosperous Christmas and a new year. Take care and bye for now.